Hello, my name's David Miller and I'm the manager of Nexus Global Solutions portfolio and the co-manager of Dynamic. It's early February and I'm speaking to you from London. Well, a month ago I was reporting disappointing numbers for 2018, albeit linked to good long-term numbers. And I highlighted the issues that had upset markets. And I think to start today, what I should do is just go over those issues, because January was a much better month for investors. Solutions was up over 3%, Dynamic close to 5%, so pretty well December setback has been wiped out by January gains. So why is this happening? Why is this volatility? Well, a month ago I talked about three main issues and a peripheral one. The first one was US interest rates, the cost of money. And at that time, in the latter part of last year, the Federal Reserve was talking about significantly higher interest rates in 2019. Since then, they've changed their mind. The last statement was fairly supportive. Possibly the next rate rise will be down, not up, so a big change of policy. Secondly, there was the US-China trade war. The rhetoric was heating up in December. That was unsettling. Now they're talking to each other. These two things, very important. And the final part of it was the Chinese economy itself, which has been slowing down for a while now. But this has been recognized by the Chinese government that is doing its best to stimulate growth. So three things that were worrying investors in the latter part of last year are much less tense now towards good news. And that's why markets recover. Markets don't move on the headlines, they move on what is going to happen next, and what's happening has been basically good news so far this year. And then the third issue, no real progress to report on this, is Brexit. It remains very uncertain. If anything, the judgment is that the deal will be softer than hard, and we watch this space. But markets are moving ahead of the votes that are happening in Parliament and the 29th of March on that basis. So as I said, some good news came through and we were in a good position with the portfolios to benefit from that, because we remained committed to markets, focusing on what we do and trying not to be too clever about the short-term timing. Markets actually bottomed on Boxing Day, when the Americans went to work, but the rest of us didn't. And that shows you the difficulty of saying, I'm going to come out to go back in and I'm going to buy at the bottom. Asset allocation, pretty well unchanged. We didn't see the need to change the asset allocation. So the Solutions remains about 29% invested in fixed interest stocks and cash, mid-50s in equities, and the balance in alternatives. Dynamic, 95% in equities, global equities 5% in cash. Not much change there. The recovery in January, the growth in January, was pretty well across the board. All asset classes made money. So in equities, there were some better parts, but basically everything went up. US technology performed really well. AMD, for example, went up 30%, over 30% in a month. But the others also did well. It's very hard to argue with 30% revenue growth. If a company can deliver that, there's a good price, or there's a price to be paid for that. And we certainly saw that in the last few weeks. Investments gone into the portfolios is Diageo. That's a company that seems capable of delivering 7–8% revenue growth, just because of the quality of what it sells and where it sells it. These are companies that are very valuable in the current environment. So the portfolios responded well. We've got off to a good start for the year. And I suppose the issue then is, what about the future? Well, we've got reasonable economic growth around the world. The company results are coming through fine, in line with expectations or better. And as I said about the US technology companies, the actual growth is really good and therefore of value. That's a very firm foundation from which to work off. So then you look at the other parts, and I said last month, watch the numbers, be flexible. I haven't changed that as a way of operating. What numbers matter now? It's going to be global growth, it's going to be US growth. If there's a sign that the slowdown is getting out of hand, we'd have to do something about it. On the other side, we've got inflation. Not much sign of that at the moment. Keep a close eye on it. So very important to be flexible and to be able to react to the information as it comes through. Then we've got the politics. Never looks particularly good. Hasn't been disturbing global economic growth and the companies that we're investing in so far. But there's always a possibility that either Brexit or President Trump will upset things. So watching it, but not necessarily changing the portfolio because of the headline news. And the final thing, quality, liquidity. I think at this stage of the economic cycle, it's so important to know why you're invested in something. Is it a company that's going to produce a good return in terms of profits growth? Can it afford to pay its dividend out of resources, internal resources, rather than borrowed money? And liquidity, just the ability to change direction. These things matter hugely. So that's where we are now. I think a decent start to the year. I think more to come over the next few months in terms of news, and I look forward to reporting to you in a month's time. Thank you.